expectations for this consumer price index report were that they would continue to decline from the numbers that we saw in the December report, which showed 6.5% year over year inflation, and key cooling off occurring in goods inflation specifically. We're starting to see some stuff in services, but by and large, what we were seeing was goods inflation beginning to cool off. The headline reports that we saw this morning for January were slightly higher than expectations, but I would say within a rounding error of overall expectations for what we would see from the headline numbers. So let's start right there. Headline inflation up 0.5% month over month. I believe expectations were for a 0.4% increase. Year over year, 6.4% year over year. So a decline from last month, but again, slightly hotter than was anticipated, I believe.
Yeah, I think we'd been lulled into a sense in markets, not us, just collectively we, the whole country, investors, however you want to think about that, had been lulled into a sense of complacency by a few months' worth of good readings, which were expected because energy prices were coming down.
Yep.
So favorable year over year and even month over month comparisons made for, and ultimately illusory. I think we will see whether or not today's reading bodes what it bodes for future readings. We
Sure.
don't want to read too much into any data point, but a few months maybe gave us a false sense of relief due to falling energy prices, and that reversed modestly. The big stories this month, I think you already pointed out, shelter increasing 0.7% month over month and nearly 8% year over year. That was a driver of about half the month over month inflation change. And that seems fairly well dug in. And services inflation, as you pointed out, Mike, has taken the baton from goods inflation. So we've got goods deflation now.
Yep.
Now that the pandemic phase has passed, and we're into services inflation.
So you want a
And
car, you want a board game, you need a new video game console. Those things are not going for quite as much as they were over the last few years, or at least the pace of increases is slowing down. But, talk to me about services. I mean, look, when it comes to services inflation, I think the primary one here, making up a third of CPI, is shelter. So digging in there a bit, that is one area that I think there's been a lot of expectation of a cooling off, and yet we are still, I think the average month-to-month increase on shelter costs has been 0.5 or 0.6%, and we got a 0.7% reading this time. Any takeaways there?
Other than that, it's indicative of persistent underlying inflation. No, I don't have any deep insights. And I think it's important to keep in mind the big picture, which is that which the Fed can control, which is monetary inflation, underlying inflation, trend inflation. Some people call it core inflation. These are all synonyms. So forgetting for a moment about the trees and looking at the forest, there's evidence of mid-single-digit, persistent, dug-in, whether you look at expectations or wages or supercore or core, and we can get into the nitty-gritty of those, but that's, to me, less important than the fact that underlying or trend inflation is persistent and fairly well dug in, and it's going to require some economic pain to uproot and ultimately squash.
So that was your perspective. I mean, I know your perspective on things going into this report, right? Like, you and I spend a fair bit of time together, whether you like it or not. So I know that your perspective has been, hey, we had a few good months of data, but the concern would be, hey, do things trend back up in the other direction? Do energy costs bring overall prices back up? To you, I don't think it's any one piece that brings prices back up, but are we going to be able to see that persistent drag down or that disinflationary pressure that we have been seeing?
Where's that going to come from has been my question throughout. Historically, every monetary tightening, every hike in rates by the Fed of the Fed funds rate, that short-term interest rate that drives up treasury bills, et cetera, that's always been associated with a slowdown in economic activity, which pushes up unemployment, which puts downward pressure on wages, and that helps to subdue inflation. It would be odd if inflation came down without economic cost, because historically, disinflations, not just the 70s, but other periods too, and not just in the United States, globally, historically, disinflations inevitably are accompanied by some economic sacrifice.
Taking a look at a few individual components here. So shelter, as we mentioned, makes up over a third of headline CPI. It continues to run hot. My takeaway there, just getting away from the overall headline, would be going to be tough to see a slowdown in shelter costs if you have a hot housing market, right? I mean, overall, interest rates have come down from those 7% peaks to now below 6% on the 30-year mortgage. Clearly, there's some excitement again about housing. I'm having a tough time understanding where that, there's been a lot of people calling for some relief on the shelter cost of the index. I don't really see it unless you see an overall housing cool-off, and there's nothing indicating that today.
I mean, it could happen, and this is just a philosophical difference between the way I look at inflation and maybe some of the bottom-up forecasters that you've talked to on the show look at inflation. I don't find building up from individual components to be particularly helpful, because if you've got underlying inflation, it's like you got water in your house. It comes in through a shingle, and it ends up in the bathroom downstairs. How the heck did it get there? We don't know. The larger point is that there's water building up on your roof, and it's going to make its way into unexpected places. This, to me, is a decent analogy for inflation. There's too much money in the economy, ultimately. That pushed up the level of prices. This, I'm being a little bit abstract here, but it helps me to not get bogged down. We could talk about shelter. It's interesting.
Yeah.
It is over 34% this month if you look at the table breakdown that they update with every report of inflation. So it's going to, by necessity, drive it. It's a big component. Yeah. Food is 13.5%. Energy prices, surprisingly, a little less than 10%. So, but they're very volatile.
Right.
So that's how they become a driver. But to me, the bigger problem, going back to the water in the house metaphor, if I may, is that there's a lot of water on the roof still. And until we take care of that fundamental problem, too much money in the economy driving up prices through wages, and the best evidence of this is a hot labor market, whether you look at vacancies or unemployment, et cetera.
So, Mark,
Brendan,
would that is that really kind of the indicator? This idea that it's really focused in housing, that this is a much more systemic problem than this idea that, and we know this idea of it being transitory is long in the past, but that transitory piece, that seems to be where the goods are, right? We've kind of cured the supply chains and that sort of thing, but now it seems to be very systemic. It's kind of built in, as you said. There's too much cash in the system. Would you view this as being proof of that?
I probably wouldn't use the word proof, but that's just a personal preference, because you could always be disproved. So I'd say it's strong evidence of it, yeah.
So
1 month it shows up in one component, another month it jumps around, which is why we like here, and others do as well, median or trimmed mean CPI. We'll get data on that later today. It takes out the outliers no matter where they originate to give you a sense for what is going on in a trend sense, and that's what we want to get at.
So, Mark, I'm going to make you play a little bit of mental gymnastics here, because I know your perspective on this, and your perspective is, hey, this is going to be very difficult to defeat. That is clearly, at least over the last few months, not necessarily the market's position on this. And so we're seeing positive returns so far from all three major indices. I guess my question for you would be, the report that we received today, in my view, it's probably a B-, maybe a C+ in terms of doing what we need to do to prove disinflation. How do you think market participants are taking this data so far? Because, like I said, markets are up slightly. Was this just a, hey, good enough report?
I don't see how it could be viewed that way. So I'm at a little bit of a loss to explain market reaction. This tells me that Fed funds probably have to go to mid-5s or higher. We've been in the 6%. I don't want to tarnish you with my views, but I've been in the 6% plus camp, just using basic rules of thumb. No, I don't claim any great foresight, but historically, you got to get Fed funds up higher than the rate of inflation so that the real Fed funds rate is enough to slow down economic activity. We're not anywhere near that point yet. How markets, equities in particular, which should be trading lower if expected interest rates are higher, which I think they probably are for any reasonable person today, how they can be trading higher, I don't claim to understand.
So then let's take out the day-to-day movements or minute-to-minute movements of the stock market, because who the heck knows? There's millions of participants deciding that.
Fair point.
Give me one person's view. Give me Jerome Powell. Jerome Powell came out at his last meeting and said, look, he's always going to be pretty conservative in all of this, but he used the word disinflation on more than one occasion. And to me was a pretty, I don't know, it was a pretty dovish series of statements compared to where he has been over the last few months. Yeah. Again, I know your perspective on this, but is this report enough to change Jerome Powell's mind?
I don't know what Jerome Powell's framework is. I don't consider him to be a particularly effective or competent Fed chairperson. I think he needs to.
Not asking that question.
Okay, well, but it's important that I state
Yep.
that because I have a hard time getting inside of his mind.
Yep. That's fair.
Because he doesn't seem to have an analytically consistent approach to this problem. One press conference, he's saying financial conditions aren't a concern. Another, he's underscoring them. He's confused real and nominal interest rates. I mean, he's much smarter than I am, but he clearly doesn't have training in this particular. Yeah, I mean, he's an established, successful private equity investor, among other things. But in this domain, he lacks training, and it's painfully obvious when he speaks. He gets concepts confused. So I don't have a lot of confidence in his leadership, and I think that's borne out by the inflation experience of the past 3 years, frankly.
So would your takeaway be that this report might not be enough to change his mind, but it should?
I don't think his mental framework is established enough to predict how he will respond to something like this. This could send him off the deep end in the other direction, like the parent who sometimes discipline their kids, other times they're very liberal, and the kid's behavior is all over the place as a result. I don't know. I'm stretching for metaphors here. Mike, help me out.
No, you're
You know
good.
what I mean.
Yeah.
The guy doesn't have a philosophy, an approach, a framework, and I think in the modern era, you need somebody in charge of monetary policy who does. I don't know how he thinks about the world. This could send him, again, over the edge because nobody wants to be called a wimp.
Yep.
And if he fails, he'll be one of the biggest monetary wimps in history. So he could overreact.
Mark, can you tell us how you really feel about all
But
this?
right,
Don't hold
isn't it
back.
true though?
Can you please?
Does anybody remember Arthur Burns? You know the name Arthur
Yep.
Burns. He was Fed chair, and he was a Republican, conservative, CEA chair, intellectual giant, failure. His whole career was one success after another. He was a golden boy until he failed at the Fed. Now he's a poster child for monetary failure. But that's about to be updated with Jerome Powell's picture.
Whoa.
Right? Isn't
Happy
it?
Valentine's
All
Day,
right.
Jerome.
Big kiss to Jerome.
Well, Tucker, if we were ever going to have Jerome Powell on the show, I guess you can scrap that.
Oh, yeah,
much
he might-
appreciated.
Check my
He might
calendar.
come
Do
on
it when
soon.
I'm on
Yeah, he's
vacation.
gonna yell
Yeah, he's
at
going to be
us.
showing up at Marc Fandetti's doorstep, not on the.
But
not on
I'm
the
saying he
Financial
could actually
Exchange show.
overreact here to prove his monetary masculinity
Because of you.
because of this
Thanks
show.
a lot. You might just send interest rates through the roof.